In today's video, you will learn the 3 myths and facts about crypto you need to know. Like most people, you probably understand crypto as some magical, untraceable internet money used by criminals on the dark web, a scam, and little more than a Ponzi scheme. Well, you're mistaken because crypto is not any of those things you think it is. But before we start, kindly support my work by liking the video and subscribing if you are new. That said and done, let's roll into it. Myth 1. Crypto is too volatile. While cryptocurrency's price can be volatile in the short term, it has shown stability over time and has even outperformed traditional investments in some cases. Volatility is simply the rate at which the price of an asset, in this case a cryptocurrency, increases or decreases for a set return on investment. It refers to the speed and degree of price changes. High volatility means that the cryptocurrency's price can change dramatically over a very short period, making it possible for investors to experience significant gains or losses. Crypto assets are often much more volatile than the government-issued currencies. Factors such as regulatory news, market manipulation, technological advancements, market sentiment, macroeconomic trends, or even a social media post by a prominent figure can cause significant swings in cryptocurrency prices. On the one hand, the potential for rapid price appreciation is more significant. On the other hand, there is the potential for a substantial price decline. Therefore, while the potential for high returns can be attractive to some crypto investors, the increased risk associated with volatile assets like cryptocurrencies may not be suitable for all individuals. In short, the myth that cryptocurrencies are too volatile refers to the idea that the prices of cryptocurrencies, such as Bitcoin, are too unpredictable ever to be considered a reliable store of value over time or a dependable medium of exchange. These functions make money a critical component of modern economies, facilitating economic activity and growth. While cryptocurrencies like Bitcoin have seen high levels of short-term volatility in the market cycles, many have also demonstrated a significant increase in value over the long term. Bitcoin, in particular, has shown a dramatic price increase since it was first launched in 2009. Despite the periods of steep price drops, its overall trajectory over the years has been upwards. This trend has been seen in other blue-chip cryptocurrencies like Ethereum. However, it's crucial to remember that past performance does not guarantee future returns. Various complex factors influence the crypto market and can be highly unpredictable. For this reason, potential investors should carefully research and consider their risk tolerance before investing in cryptocurrencies. As with any form of investment, there's a level of risk involved in crypto investing. Cryptocurrencies should be just one part of a diversified investment portfolio, and the percentage allocated depends on your short-term and long-term investing goals and the nature and mix of your portfolio, which you determine in consultation with advisors with solid knowledge of the crypto asset economy. After all, your money has to do a lot of work for you. While cryptocurrencies are subject to price fluctuations, remember that crypto fluctuations don't occur in a vacuum. The crypto economy is a microeconomy within the larger macroeconomic environment, and volatility in the cryptocurrency market, an emerging asset class, is not unique to crypto. Additionally, volatility can decrease as the market matures over time and adoption increases. Myth 2. Crypto is just one big scam. Every type of cryptocurrency has unique features that are not interchangeable. Investing in a cryptocurrency, like any investment, carries risk and requires research and careful consideration. Crypto is not a guaranteed way to make quick profits. Although there have certainly been fraudulent schemes involving cryptocurrency, the technology and its underlying principles are legitimate. Although the US dollar is the #1 currency of choice for criminals across the globe, the cryptocurrency industry is undoubtedly the target of fraudsters. But the myth that crypto is nothing but one big scam is one of the biggest crypto misperceptions. The belief that all cryptocurrencies are scams is a myth based on a fundamental misunderstanding of the nature of the technology. Crypto at its core is a software-based financial technology that is a decentralized digital form of currency based on cryptographic principles. It's a revolutionary financial innovation with the potential to reshape the global economy. Many cryptocurrencies, like Bitcoin, have robust and transparent underlying technologies and have been adopted by retail investors, large financial institutions, and even the country of El Salvador. However, like any other industry, the crypto market is not free from bad actors. Scams, frauds, and Ponzi schemes have occurred in the space. So it's important to distinguish between these malicious activities and the legitimate uses of cryptocurrency. Myth number 3, crypto is bad for the environment. To prevent fraud, Bitcoin blockchain software is programmed to use a consensus algorithm called proof of work, where computational power competes to validate transactions by solving complex mathematical problems. This process is called mining and creates new Bitcoins to reward the miners. This validation process occurs approximately every 10 minutes. The initial Bitcoin block reward was 50 newly minted Bitcoins. Roughly every 4 years, the reward amount is reduced by half. This event is referred to as the halving. The block reward was halved to 25 Bitcoins in 2012 and again to 12.5 Bitcoins in 2016. In 2021, miners received 6.25 Bitcoins for every new block after the halving. In 2024, the Bitcoin mining reward is expected to reduce to at least 3.1 Bitcoins per mined block, and at this halving rate, the last Bitcoin will not be mined until around 2140. As of 2023, about 19 million Bitcoins have been mined and are in circulation, leaving approximately 2 million left to be mined. Crypto mining consumes significant energy, which can have environmental impacts. However, it's essential to correct the conversation about the technology and challenge uninformed blanket statements that cryptocurrencies are inherently bad for the environment. First, not all energy used in crypto mining is non-renewable or environmentally harmful. An increasing number of miners are utilizing renewable energy sources, such as solar or wind power. Some miners even use the excess energy that would otherwise be wasted, thus making their operations more environmentally friendly. Secondly, traditional financial systems like banks and credit card companies consume massive amounts of energy, significantly impacting global environmental concerns. These systems require physical infrastructure, employees commuting to work to locations worldwide, and depend on enormous servers running the whole day. Compared to this, blockchain energy is not nearly as great as it first appears. Additionally, the technology behind cryptocurrencies, blockchain, has potential environmental benefits. It can be used to create transparent and efficient systems for tracking carbon emissions or renewable energy certificates, thereby playing a critical role in climate change mitigation efforts. Lastly, the high energy consumption of crypto mining is already encouraging innovative technological advances in energy efficiency. The high energy cost for mining operations incentivizes the development of more efficient hardware and pursuing cheaper, renewable energy sources.